Hey, it's Rick. It's Sunday, 2nd of April. March is in the books and done. I haven't done a video for a couple of weeks, but I wasn't going to do one again this weekend, but I just noticed something in my model, which is up on your screen. This is the first time since I created this model over a year ago that it is all green. All trends are up. I'm stretching it a tiny bit with the S&P, as we'll get to in the chart in a second. It's really flat, but it is turning up, but the Qs have turned up. So this is, uh, yeah, unusual. A welcome sight, actually, after a year being really struggling in the market. Does it mean we're all clear? And get this out of the way. And it's all guns a-blazing? Not so much. I mean, one of three things could happen. This is the weekly chart of the S&P here. Let's just move this out of, move it over here, get a better view. One of three things could happen. This could indeed be the start of a bull market, in which case we rip higher from here. That's one option. It could be just a bear market rally, because we have been coming down, although we've now sort of set a higher a higher low, and potentially have a couple of higher lows, but there's nothing to guarantee that this won't just sort of roll over and head back that way. So that is another possibility. But the one that I favor most, I think, is going to happen is we're going to be stuck in this box here, this trading range from here to here for some period of time. Now, if we are going to be in a box, get my tool to work here. I would hope that it would get expanded a bit. This didn't work out very well, and encompass this. We're still means basically we're in a trading range. However, that range is having trouble with the tools. Sorry about that, team. Here, let's just do that. That's a pretty wide box, which give us, I mean, for you that are investing in the indexes, it's really going to mean dead money for some period of time if this indeed happens. Or God forbid you're in mutual funds, same thing. It's just going to be basically dead money for a year. But there will be lots of opportunities for stock picking and perhaps even sectors, because as money rotates from one sector to another, there should be some opportunities. So those are the three probabilities, three outcomes that could happen. Personally, I'm just taking advantage of this little move here for the last couple of weeks. I have fully loaded up. I think I'm now 82% invested in my registered accounts and 73% in my trading accounts. But I have very tight stops. 18 of my position. I have 18 positions, which I can't recall ever having. Most of them are small, although this week, because the market is looking better, I've started to size up a bit. I'll show you the two that I took on Friday, and I took some decent size. And like I say, all 18 are profitable, and my stops are at break even or better in many of them. So my overall portfolio risk is very, very small. In fact, it's less than 0.8%. So if everything gets stopped out, the hit to the portfolio is only 0.8%. So not a big deal. So it's a good environment to be in temporarily, but I'm going to keep a really tight leash on things. So that's what I think could happen. I did go through all the sectors this weekend, but I really find nothing of interest to my style of trading. There's a couple of things that you definitely want to avoid, and that would be banks and real estate, particularly commercial real estate. Technology looks really good, and the QQQs, if I just pull up the Qs, they've been performing very well, much stronger than the S&P, and this 40-week moving average has definitely started to turn up. But this is being driven by Apple, Tesla, Microsoft, and NVIDIA, and those four. The QQQs is only 100 stocks. Actually, technically, I think it's 101. But those four, I think, account for almost 40% of the index weighting. So that's been, in the light of the banking crisis. I think a lot of money moved out of. You look at the small caps. They haven't performed near as well because something like 18% of the small caps is financial institutions. So money has been rotating into these big cap companies like Apple and Tesla, Microsoft, more out of safety than anything else, because their earnings are not terrific. There's no reason for these stocks to be up the percentage that they are from a fundamental perspective, but so I think it's just a sort of a flight to quality. So the edge might come off that a little bit in the next couple of weeks, but we shall see. So that's that. So there's really nothing in the way of to do. I think everybody should be. I think I indicated back here that we should be 25 to 50% invested. I wouldn't go beyond that yet. It's getting closer. Go back to the SPY. It's getting closer to the point where we could get to 100%. Wrong chart. Sorry about that. We could get closer, but I wouldn't be fully invested yet. So I think 50% is a comfortable number with the balance of the funds in money markets. And keeping still a pretty tight stop. I think the distance between where we are now, the logical stop would be down around here. That's 8%. So that's my maximum tolerance for risk. So if you have 50% of your money's invested, and it does indeed go down by 8%, the total hit to your portfolio is 4%. So not the end of the world, but wouldn't be pretty. But quite honestly, if it starts testing this 40-week moving average again, I would be lightening up there, and then so minimize the losses. Okay, having said that, I'm going to go to the daily chart. Get this out of the way. What gives me pause to some things are starting to work. As an example, Friday, I bought MNST, Monster Beverage. This is a $50 billion non-alcoholic beverage company. And you can see it's been in a base. Go right here, go back to the weekly. It's been in this base for a year and a half. And Friday just ripped out of it on good volume, above average volume. So this isn't Aunt Betty and Uncle Bill buying this. The institutions of there's something going on here because the earnings are not stellar. The growth is, at least for the last couple of quarters, has not been stunning. So, but somebody knows something. So, and a lot of these, what we call breakouts, for the last year have just not worked. They've gone up like this, and then intraday just came right back down, and then come back into here, and they're just not working. And now, finally, this past 3 or 4 days, past week, we're starting to see these breakouts work. So that's a good sign. So it could still fail. I got in fairly early on this one. The alert went off. And it's closed near its high. And I had my stop way down here somewhere. I've now raised my stop to break even. So my thought process there is quite simple. If this is truly institutional buying, they're not done. They never buy their whole what they want to get in one day. It sometimes takes them weeks to accumulate their positions. So the buying is not done. So if this does actually take out Friday's low, the institutions are saying they're not willing to support it. And this was more retail driven. And so, yeah, I get the hell out and look for another reentry perhaps, but so far so good. And the other one that broke out on Friday was Academy Sports. And again, this is not a rinketing company. It's their market cap is a $5 billion retailer. So it broke out of its clear trend line. And again, I've got a pretty well-defined stop right under this base right here. So it's good to see these work because in the last little while, I've taken a few of these trades and they just didn't work. You know, they came out, hung around here for a couple of days and fell right back in. So this one may do the same, but I'm just a little bit more encouraged that I could get up to 73% invested. And a couple of Canadian ones that are working. Software developer. What is it called? Descartes Systems. I don't know anything about them. I think they're based in Montreal, but I got in down here and it broke when it went to a new all-time high, or 52-week high right here. This day back here a few days ago, a couple of weeks ago, I guess. And didn't get too panicked on this pullback. And then it made a nice rip on Friday. So that was looking good. And then West Shore Terminals. Chart on this is not quite as pretty. You can see it's a downtrending 200-day moving average, which normally I'd avoid. But I put this one on my longer term account. Again, with a fairly tight stop. And it's performing nicely so far. And then the last one is paper company. Yeah, again, it's up near the highs. It's just a 52-week high, not near its all-time highs. And this is a downtrend line that actually did work. I bought it here. And I'm actually looking to add to this one if it gets up over these highs up here. I have a sizable position in this one now, and I'm looking to add to this one. And I can move my stop up into this range here. So there's a few things that are working. But I say you have to be right now it's a stock picking market and you have to be quite selective. Can't think of much else to add. Probably be a quiet week. I say with this big move, I'm expecting, S&P has gone up, not straight up, but we're into this area here where you'd expect this is going to stall around. I mean, in an ideal world, what would be nice to see would be we stall right here, maybe come down a bit for a couple of days, tighten up. See these bars here are fairly wide. And it's not what I'd like to see. See these big wide bars here, big ranges. They're dangerous. I like it when it's much tighter than that. So if we can get a few days where it's tight, pulls back, maybe, and then rips out from here again, it makes it a little more interesting. But quite honestly, got the wrong chart here. One that's all marked up. I'm not really terribly interested until we get above this level here, which is it's only a couple of percent to go. So, but it's looking better. Keep your powder dry. Keep on the ready. You never know. This could be the start of a bull market, in which case we could rip 20% this year. So, okay, that's it. That's all.